Gold is up, but nobody's excited yet. And in part, that's because you got Bitcoin doing spectacular things and NVIDIA doing spectacular things. So gold going to its all-time nominal high, but not its inflation-adjusted high, pales into insignificance next to the other bubble stories out there. Those bubble stories will eventually burst, and gold is probably going to go a lot higher because of all the monetary stupidity that's going on out there and the really demand tightness that's going to come from the central banks buying and from investors. It's going to be a dramatic bull market in precious metals in which gold leads to begin with, and then silver leads in the later stages.
In the realm of financial forecasting, JohnRubino highlights the growing uncertainty surrounding global monetary policies. He suggests that as speculative bubbles potentially burst, precious metals like gold and silver are poised for a significant bull market. Rubino particularly emphasizes silver's potential to shine in the later stages of this market cycle. Last Wednesday, the Federal Reserve opted to maintain its current interest rates, but kept the outlook for 75 basis points of interest rate cuts for the year ahead. This decision, signaling the Fed's lack of concern regarding overheating in the U.S. economy, contributed to a weakened dollar and propelled the price of gold above $2,200 per ounce for the first time. Moreover, silver, which had lagged behind gold in recent weeks, showed signs of regaining ground and could outperform gold soon if the current rally persists after last week's pullback. Despite its recent subdued performance, Rubino asserts that silver remains an appealing investment opportunity due to its dual role as both an industrial commodity and a store of value. Supporting this sentiment, Goldman Sachs Group Incorporated forecasts a 15% return on commodities in 2024. Primarily driven by anticipated rate cuts from U.S. and European central banks. Rubino urges investors to position themselves strategically in anticipation of the rally in silver prices, warning that delaying action could mean missing out on the early stages of the upward trend. This proactive approach aligns with his belief in the potential for silver to surge amidst the evolving economic landscape. Join us as we delve into insights shared by JohnRubino. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
It's been so boring for so long that an awful lot of people have just stopped paying attention to it. So we can go to 27 or 28 without those people who used to be in silver even knowing that that's happening. So it needs a pop to reattract momentum buyers and the old silver stackers and silver bugs. And yeah, part of the problem is that it's an industrial metal. So, but if it was just an industrial metal, it would still have a great story right now because the world's silver mines are not producing as much as the world's silver users are taking off the market right now. So it's in deficit, and deficits that go on for a little while turn into shortages where people have to pay up to get what they absolutely need. And at the same time, there are new technologies coming along that use silver. There's solar panels. Next generation of solar panels use a little more than the current generation of solar panels do in terms of silver. And there are fuel cells being developed that use silver to replace platinum. So you've got some very positive usage trends out there in the silver market while supply trends are flat to down. Mexico is not producing as much silver as it used to, and the Mexican president just floated the idea of banning open pit mines, so that won't help the supply of silver. If you just looked at it that way, if silver was named tin or nickel or something like that, and you just looked at the supply demand dynamics from industrial users and mines, you'd say, okay, this is headed for a shortage and headed for higher prices because of that shortage. And then you add in that it's a monetary metal, and it tends to follow gold during precious metals bull markets, and we seem to be entering a precious metals bull market. The silver story looks awesome. I am still a buyer of silver even after all these years, because of that. I think that at some point, see, when gold gets to a certain point, you also have the aesthetics of the whole thing coming in. You can buy one Krugerrand, right? And it's pretty, but it's very small. And then you think, how many ounces of silver, which piled on a table is really a gorgeous sight, how many can I get for the price of that one Krugerrand? People tend to start buying silver because it's much cheaper than gold, but it serves the same function. It's a monetary metal. And then the bull market really takes off and silver dramatically outperforms gold. That's the way it's gone for the past few precious metals bull markets. No reason to think it won't happen again. It's just that we're in a very early stage of this process. Gold is up, but nobody's excited yet. And in part, that's because you got Bitcoin doing spectacular things and NVIDIA doing spectacular things. So gold going to its all-time nominal high, but not its inflation-adjusted high, pales into insignificance next to the other bubble stories out there. But those bubble stories will eventually burst. Gold is probably going to go a lot higher because of all the monetary stupidity that's going on out there and demand tightness that's going to come from the central banks buying and from investors. It's going to be a dramatic bull market in precious metals in which gold leads to begin with, and then silver leads in the later stages. So there's a 2 or 3 year stretch out there where silver is the best thing in the world to own. And we kind of have to be there ahead of time, right? Or else we miss the beginnings of the big move.
Gold has stood the test of time as a coveted commodity, finding its place in investment portfolios for generations. Over the past 2 decades, it has delivered compelling long-term returns, averaging approximately 8% annually. However, its journey has been marked by significant price swings, experiencing a downturn of around 40% from 2011 to 2015, only to rebound fully in 2020. JohnRubino suggests that gold's current ascent may be a correction to its undervaluation. Some proponents argue that its actual value could be as high as $5,000 per ounce. Although the necessity for holding gold as a reserve asset has diminished, its inherent scarcity continues to attract central banks seeking a reliable store of value. While the role of gold in central bank reserves has fluctuated over the past 2 decades, these institutions collectively hold approximately 20% of their foreign exchange reserves in gold. Rubino highlights the significant demand from steadfast investors, often called strong hands, effectively withdrawing considerable gold from the market. This dynamic leads to tighter supply-demand dynamics, propelling prices higher in response to heightened demand. Let's get back to the interview.
As for what's triggering the move, there are 2 answers. One is that gold should be $5,000 an ounce anyhow. So it's if it goes up, it's just because it should have been much higher to begin with, and we don't need to think about it anymore. The other part is central bank buying. All of a sudden, the central banks are whales in the gold market over the last 5 or so years. They've gone from being fairly aggressive sellers of gold to very aggressive buyers. So the last 2 years, these are just official numbers, they could be much higher, but officially, central banks have bought 1,000 tons of gold in each of the last 2 years. And that's maybe 1/4 of the world's mine output just being taken off the market by very strong hands who aren't going to be trading it. If you're the People's Bank of China, and gold goes up another couple $100 an ounce, you're not going to turn around and sell what you've bought. That's your monetary base now. You're just going to put it away and hold on to it in anticipation of some kind of a big currency reset out there in which gold almost certainly is revalued to a much higher level. Gold, the supply-demand calculus right now is much tighter than it used to be because you got these whales in the market taking so much off the market. And that's probably a big part of what's driving the price of gold higher generally. And the other more near term is the Fed stuff that we talked about, right? If they're going to start lowering interest rates in the face of sticky and too high inflation, then we're in kind of a stagflationary environment, which is phenomenal for gold. There are some people looking back to the 1970s going, yes, that's what's happening again. And I missed being all in with silver in the late 1970s. I'm not going to miss that again with gold and silver. I'm going to load up because that's what's happening again. So you have several different parts of the market all kind of reacting in a bullish way right now, and that's helping gold. If it's the case that the central banks are still going to be buyers and people are going to replicate the 1970s in their investment portfolios, then yeah, gold should just take off from here. Less spectacular, but still pretty favorable scenario is that 2000 used to be resistance for gold, and it bounced off of it and bounced off of it and bounced off of it, and finally pierced it. And maybe 2000 or 2200 is the new resistance and 2000 is support. So we're maybe going to be back in a trading range, $200 an ounce trading range, but a higher trading range, which is good for the miners because that means they've got sustained higher margins going forward, which means more cash flow and positive quarterly reports and things like that until people finally, rediscover the miners and get excited again. So the modest scenario is still pretty good for precious metals and possibly very good for the miners in this case. So I'm optimistic, intermediate term about both gold and silver and the miners. I think at, say, $2,100 to $2,200 an ounce gold, you do get some margin expansion for the most efficient operators, and we'll get some reasonably positive quarterly results. And I think that'll help. Now, $2,500 gold would help more. but I still think that the mining industry generates free cash flow at today's levels. In the case of the best, most efficient miners, there are outliers in the negative direction who are just going to have trouble making money no matter what,
I was going to say always.
So you want to own quality companies in that space because they're the ones most capable of taking advantage of positive trends in the industry. And then maybe you want to look at the royalty companies because they basically just have contracted amounts of gold and silver coming their way without having to deal with energy costs or even labor costs. They have incredibly small staffs relative to their revenues. And that might be, in this kind of an environment where costs are going up, that might be a better place to be for precious metals mining investors.
Considering John Rubino's emphasis on positioning strategically to capitalize on the anticipated rally in silver prices, what factors would you consider when making investment decisions in the current economic landscape? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.